Right now, this looks like a perfect place to buy. And this is exactly where most beginners enter. But in a few seconds, the market will drop and take all their stop losses before moving up. Because what you see as support, the market sees as liquidity. Now watch carefully. I'll show you where the real entry is. Now first, focus on this area. Here, the market breaks the previous high. This is what we call a break of structure. This is important because it tells us something very specific. The market is no longer moving down. It is now showing signs of moving upward. And this is exactly where most beginners get confident. They see this break and they think, okay, the market is going up. Let me buy now. But that is the mistake. Because a break of structure does not mean immediate entry. It only gives you bias, not confirmation. It tells you the direction, but not the timing. And if you enter just because of this break, you are entering too early, before the market has taken liquidity. Now, after the break of structure, I am not entering the trade. Instead, I wait for price to come into this area. This is my point of interest. This is the zone where I expect smart money to be active. Not where beginners enter, but where professionals wait. Because the market does not move up immediately after the break, it first comes back to a strong area before making the real move. And this is that area. But here is the important part. Just because price reaches this zone does not mean I enter instantly. I still wait. Now this is the part where most beginners get trapped. Price reaches near the point of interest and then starts moving slightly upward. This creates confidence. Traders think the move has already started, so they enter the buy early. But this move is not real. This is inducement, designed to pull traders into the market, to create liquidity for the real move. Right after this, price drops again. It takes out those early entries and collects their stop losses. Now, once liquidity is taken, the real move begins. Price starts moving upward with strength, but this move is not random. The market is now targeting buy-side liquidity. This means all the stop losses and pending orders sitting above these highs. That is where the market wants to go, because liquidity is the fuel that drives price. So instead of taking small, random targets, I align my trade with this move and hold until price reaches that liquidity above. Now this is where I take the trade. After the break of structure, price comes into my point of interest, but I do not enter immediately because the market creates inducement to trap early buyers, and then price drops, taking that liquidity. But right after that, price shows strong reaction. This is the confirmation I wait for. This is where I enter the buy. After liquidity is taken, not before. And once I am in the trade, I watch how price behaves during the move. Because during the move, the market forms new liquidity. Price comes back, takes that liquidity, and continues moving up. This confirms my trade is strong, because what looks like support is actually liquidity.